Online guys, everybody please say hi to me. Okay, so that we'll start with the questions, banking questions. Till now we have completed so many things. Okay, based on those things, I've bought you some 60 questions. We'll see. Okay, Sudhir, Anjum, Prashanti, Srinidhi, Sana. And there are some guys in the online, I don't know what happens to them if they'll respond. I want to ask your property, guys. Fine. So we'll start with this banking questions. Okay. So we have got almost 60 questions. So see. So first question for the day is, in which year the Reserve Bank of India established in which year the Reserve Bank of India established? In which year? Everybody please answer. B. Yes. Good to go. Fine. So, see, what I have told you, Reserve Bank of India, based on the recommendations of Young Hilton Committee, it was formed. Young Hilton Committee, it was formed. And this Young Hilton Committee, which was formed in 1926, and based on the recommendations of this committee, we have got RBI Act 1934. Yes. And based on this act in 1935, we have got RBI. So establishment of RBI in the year of 1935. So the guys who told me B, their answer is wrong. Answer is 1935. So answer is C, and this is the data. Okay, done? Yes, understood? Yes, great. Now see the second question for the day. Try to answer this. Try to answer this. Huh? RBI was nationalized in the year? Guys, everyone, I need answers for this. Yes, Anjum, correct. Okay. Jay Shankar also correct. Sudhir, wrong. Prashanti, wrong. See, RBI, it was established in 1935. Okay. So, during that time, this was private organization, private company. Now what happened is, we have got freedom in 1947, and on 1st Jan 1949, we nationalized RBI. We nationalized RBI, which means before this is a private property and now this is government property. Understood? So the answer is C. Answer is C. Yes, Prashanti, Sudhir, everybody correct. Now the next question for the day. The original act under which, wait, the next question for the day is, the original act under which RBI functions is. Original act is asking. Original act. What is the answer, guys? Online guys, please. B. Yes, correct. So I have told you in 1934, Young Hilton Commission was formed in 1926, and the act came in 1934, and we have got RBI in 1935. So the act, the original act is RBI Act of 1934. Okay. Now, the next question for the day is, see, which section of RBI Act allows RBI to manage central government banking transactions? I have told you 3 sections. Yes, section 20 I have told you, section 21A I have told you, and section 22 I have told you. Yes. Now which section is this? Yes, Manjula, correct. Remaining. See, whenever you are sending your answers, I need the question number as well. Okay, so that I'll have some clarity. Yeah? Yes, I've told you this. Section 20. See, under section 22, RBI has power to print currencies. So, under section 22 of RBI Act, RBI has power to print currencies. Under section 20, RBI has power to behave as banker for central government. Under section 21A, RBI has power to behave as banker for state governments. Done? So your answer is A. Next. So the next question for the day is, RBI follows which system for currency issuance? RBI follows which system for currency issuance? Okay. Remaining also. Tejaswini C, Sana C, Ravi C. Yes, the correct answer is minimum reserve system. I have told you three types of systems. One is gold reserve system. This we haven't used. Instead of this, what we have used? We have used directly gold. When Britishers came into the country, when RBI was established, we started using proportional representative system. Sorry, proportional reserve system. The proportional reserve system means keep some reserves and in proportion you can print the currency. And now we are following is this till 1956 we have followed. After 1956, we are following minimum reserve system. Minimum reserve system. Under minimum reserve system, you need to keep value of 200 crores with RBI and you can print as much currency as you want to print. Okay, so this 200 also we have divided 115 crores in the form of gold you need to keep and 85 crores in the form of foreign currency. Foreign currency you have to keep. Okay, so answer here is C. Next question for the day is the next question for the day. Under the minimum reserve system, sorry, I have told you the answer already. Okay, so under the minimum reserve system, RBI must hold at least B. See, we have two options, B, C. Which one is correct? B or C? We have two options. One is B and second one is C. B? Sure? The option here is B. Everyone correct. See, let me tell you something. Under minimum reserve system, we need to keep 200 crores value of assets with RBI and then you can print as much currency as you want to print. But the thing here is 115 crores must be gold and remaining 85 crores, this can be forex reserves. Forex reserves, which means in forex reserves gold is also included. Yes, which means gold can be more than 115 crores as well, but minimum 115 crores. So here at least 115 crores of gold is correct answer. Okay, if it is 85 crores at least foreign securities, then what happens is here this will compromise, but this is not the scenario. Here we cannot compromise. Okay, so this is at least, and here you can compromise. You can manage this with like you can maintain 40 crores of gold. Okay, and remaining 45 crores of the foreign currency, STR, reserve currency position, anything you can do. Okay, so the answer is B here. What is the answer? B here. Okay. The next question for the day. 1 rupee note is issued by. ₹1 note is issued by. See, is issued by. Underline this word. Issued by Ministry of Finance only. Okay. See, 1 rupee note and the coins. Okay, they are designed and minted or printed, which means issued by Ministry of Finance, but they are circulated in the economy by RBI. Okay, so issued means minted or printed. Minted or printed. So your answer here is B, Ministry of Finance. Okay. The next question for the day is maximum denomination of a currency note that RBI can issue under section 24 of RBI Act is. I've told you what is the maximum denomination of currency. What is the maximum denomination of currency? See, 10,000 rupees, I've told you. See, maximum denomination of coin is 1,000 rupees. This we have done in 2015. And the maximum denomination of currency is 10,000 rupees. This we have done twice in the country. One from 1936 to 1946. Okay. And second one is from somewhere between 1954 to 1978. Okay. And this 1,000 rupees we have printed for only once 2015 to commemorate the 1000th birthday of Ramanujacharya. Okay. So remember, Srija in the end will do. Okay, in the end will do. Next question for the day. Which series of currency notes was introduced in 1996? Yes? Answer for this is A, Mahatma Gandhi New Series or Mahatma Gandhi Series. What is your answer? B will be the answer. Mahatma Gandhi New Series was after demonetization, which means after 2015. Okay. So Mahatma Gandhi series is your answer. So here answer will be Mahatma Gandhi series. Before that, till 1996, Capital Line series. This is in layman terms we'll call it as Ashoka Pillar series. After 1996, we are using Mahatma Gandhi series. Okay. And after demonetization, we are using new series. Okay. Just to confuse you guys, this question is okay. Fine. Everybody is going good. Now, the next question for the day is RBI manages government borrowings by issuing. How it will manage? I told you the story. Yes? Treasury bills and government securities. Whenever government needs money, what government will do is government will go to RBI. What RBI will do is RBI will print short-term bonds, short-term and long-term bonds. Short-term bonds are called as treasury bills. Long-term bonds are called as government securities. Now, every Wednesday, they'll call all the banks and financial institutions for the auction. Now, in the auction, they will buy these things and they'll pay money to the RBI. and RBI will pay money to the government. So this is happening by printing treasury bills and government securities. Understood, guys? So answer here is B. Answer here is B. Understood, everyone? Now, the next question for the day. RBI acts as, sorry, the next question for the day is, RBI acts as banker to which of the following institutions? Central government, state government, LIC, SBI. LIC, SBI. Now tell me this is quite important. So here you will get some clarity. A, 1 and 2. Srinidhi A. Remaining also please respond. Rahul. 1, 2, 4. We'll see. Okay, fine. Answer is A. Answer is A. So in the functions of RBI, I have told you RBI is banker to central and state government. Okay, for central government under section 20 of RBI Act, and for state government under section 21 capital A of RBI Act. Now, in the other function I have told you, this is banker's bank. Banker's bank. Which means this is not a banker for the bank. This is banker's bank. Okay, what's the difference? See, if government wants to make any payments, okay, that will be done with the help of RBI. But if banks want to make any payment, then they'll do itself. Yes, so that's the reason this is acting as a banker to central government, state government, not to the LIC, not to the SBI. Okay, understood, guys? So answer here is A. Now, the next question for the day. RBI settles interbank payments through, okay? So, let me tell you, this is not happened for you, okay? So, RBI uses all the three things and it will do interbank payments, okay? So, this RBI will use for the public funds, okay? And remaining personal accounts, okay? That you will be, I'll let you know in the banking functions, okay? When I will be dealing the banking functions in detail, then I'll let you know about PFMS, okay? As of now, answer is D, okay? So by saying this, this has not done yet for you guys, concept, okay? I'll teach you. So the next question for the day is, the function of maintaining CRR is related to RBI role as, answer here. RBI role as, in the functions I have told you. Answer here, 13th one, D, wrong. B, wrong. C, wrong. Okay, actually B is the answer. B is the answer. Why? Manjula, you are correct only. See, what happens here is, by using CRR, what RBI is doing? It is regulating the credit. Yes, if it is increasing the CRR, then credit is going to decrease. Credit is going to decrease. If it is decreasing the CRR, the money entering into the market is going to increase. So this is regulator of the credit. Regulator of the credit. So if this option is not there, then you have to choose option C. Okay, and option A, option D, nowhere in the list. Lender of the last resort, I have told you MSF. Yes, I have told you MSF will be using as a lender of last resort. So the guys who has answered D, I think you need to revise the concept again. And banker to the government, I'm getting answers for this as well. Where government and where banks. Okay, so this is not in the list. Only two things are list in the list. One is regulator of the credit. So first option for this. Okay, first priority for this. If this is not there in the option, then this is your second priority. If there is an option saying B and C, then both are correct. Yes? Understood, guys? Fine. So the next question for the day is SLR, statutory liquidity ratio, can be maintained in the form of Tejaswini C, Sudhir C, Srinidhi C. Yes, government securities. Government securities. I've told you this? Fine, good to go. Everybody, yes, yes. You answered correct. Now, the next question for the day. Currency deposit ratio, CDR, is options: RBI reserves by bank deposits, currency held by public by bank deposits, total foreign assets by total bank reserves, cash with RBI by total currency. Your answer is Sudhir B, Manjula B. All? See, CDR means cash deposit ratio. Yes, currency by deposit. If we'll write like this, then only we'll call it as ratio. I told you the currency with the public. Yes, and the deposits I have told you net demand and time liabilities. So your answer will be here B. Okay? Superb, Srija. So the next question for the day is, see, reserve deposit ratio is same formula. Reserve deposit ratio means reserve by deposit. What is the reserve? I have told you. Answers, guys. Total reserves of the bank. Yes, Sudhir, correct. Tejaswini, correct. Prasanthi, correct. Ravi Teja, correct. Superb, guys. See, reserve deposit ratio means reserve by deposit. Reserves, I have told you, total reserves. Total reserves means CRR plus SLR plus excess reserves by NDTL. NDTL means total deposits of the banks. Okay, so your answer is A here. Manjula, correct. Okay. Now, next question for the day is, who calculates CDR, RDR for monetary policy purpose? Okay, CDR means cash deposit ratio. RDR means reserve deposit ratio. Reserve deposit ratio. Why these things are calculated? One, this is calculated to check consumer behavior. This will calculate to check consumer behavior. And this will check to calculate bank's behavior. Okay. If CDR is more, then the liquidity in the market is more. Then there are high chances it is leading to inflation. Okay. So who will calculate? RBI will calculate. So using these two data, It will let you know whether inflation is there in the economy or not. If inflation is there, then what is the liquidity in the market, and whether banks they are providing the credit or not. Everything will be get to know by the RBI by using CDR and RDR. Okay, yes, yes, everybody correct. 17th one A. Now the next question for the day is, which of the following is not a part of Indian forex reserves? Forex reserves. Yes, option. Tejashini C, Rahul C. Remaining, let me know. Raviteja C, Prashanti C, Srija Sri. Yes, I've told you forex reserves will be having foreign currency, dollar, euro, Great Britain pounds, and Japanese yen. And then we'll be having in the second place gold. In the third place, special drawing rights issued by IMF. And the fourth one is reserve trenchy. Reserve trenchy position are deposits with IMF. Reserve trenchy position. So here foreign currency, yes. Special drawing rights, yes. Sovereign bonds, no. So this is your option. Reserve trenchy position again, yes. Okay. So your option here is C. So the next question for the day is SDR, special drawing rights. Special drawing rights are issued by IMF. So simple answer. Yes, everybody correct. IMF, yes, C. Yes. So the next question for the day is, which component forms the largest portion of India's forex reserve? Which means what is in the first position? 20 C. Yes, I have told you forex reserves will be having in the first place foreign currency, dollar, Great Britain pound, euros, and Japanese yen. And then in the second position we are having gold, and in the third position we are having special drawing rights, and in the fourth position we are having reserve trenches. Reserve trenchy position. Trenchy position. Okay, so this is in the first place. So your answer is foreign currency assets. So option is C. Okay. So the next question for the day is, what is the full form of RTP in the context of IMF? What is the full form? 21C. Quite simple. I mean, these kind of questions also they'll ask. Okay. See, I have told you reserve trenchy position, reserve trenchy position, which means are deposits with IMF. Are deposits with IMF. So reserve trenchy position is your answer. So option C is your answer. Okay. Okay. The next question for the day is, RBI manages foreign exchange under which act? Okay. So I haven't told you this concept. It will manage foreign exchange under Foreign Exchange Regulation Act. Foreign Exchange Regulation Act. So this is para. Okay. So this In the external sector, I'll teach. Okay, so answer is C. Fine. Now, the next question for the day is, when rupee appreciates, what RBI will do? When rupee appreciate, what RBI will do? See, I want answer for this, guys. 23. B. Prashanti B. Sudhir B. Yes. See, when rupee will appreciate, this is our market. In the market, we'll be having both rupees and dollars. Okay. When there are less number of rupees in the market, then only demand for the rupee will be high. Then only rupee will appreciate. Then what RBI will do is, RBI will buy the dollars, RBI dollars, and it will replace it with rupees. Replace it with rupees. Now, more number of rupees will enter into the market, the demand will come down, and appreciation of rupee will also come down. So here, buy the dollars and sell rupees. Okay, Raviteja, you are correct. Anjum, you are correct. Remaining, you're wrong. Okay, so whenever these kind of concepts are coming, please draw the picture first. Okay, there are high chances you can make mistakes. So please draw the picture. Fine. So the next question for the day is, RBI sells dollars from its reserve primarily to, what is the purpose? Why it will sell the dollars? See, remaining. See. Yes, when there is a fluctuation in the rupee value, okay, if I have to tell you, when rupee value is appreciating, yes, then RBI will sell the dollars into the market. Okay, that's how it will stabilize the rupee value again. So to stabilize the rupee value, what it will do? It will sell the dollars. Okay, nice. So the next question for the day is, PDMC was created in, PDMC means Public Debt Management Cell. Public Debt Management Cell. 2000. Everyone, I need answer for this. Jayshankar B, Sudhir B, Sana B. Yes, 2016. Okay, I've told you. Now public debt management is done by RBI. Okay, now there is a conflict of interest. On one side, it is doing the public debt. On the other side, it is deciding the interest rate. So there is a conflict of interest. So to get rid of this conflict of interest, government came up with public debt management cell as a temporary body, and the objective is to convert this into a public debt management agency, which is going to be permanent body and which will manage the debt of the government. But people felt like, government is targeting RBI to decrease the powers of RBI. So this was never implemented, but this came in the year 2016. Okay, good guys. So the next question for the day is, under which ministry does PMDC function? Public Debt Management Cell. Public Debt Management Cell. It will be under Ministry of Finance. Simple, Ministry of Finance. Okay. So the next question for the day is, Which of the following is or are RBI tools for exchange rate management? Okay. So this is 1, this is 2, this is 3, and select the correct option. Okay, which of the following is or are RBI tools for exchange rate management? 26, 27. Tell me the answer, guys. Huh? Yes. See, simply you can go through option elimination method. Repo rate is not your answer. So remove all the options which are having repo rate. Okay, and you are left with selling foreign currency, buying foreign currency. Yes. When your rupee value is appreciated, it will sell the foreign currency in the market. When your rupee value is depreciated, it will buy the foreign currency in the market. So these two things. Okay. Now, which of the following is the main objective of monetary policy in India? So next question for the day is, which of the following is the main objective of monetary policy in India? Guys, answer 28. C. Yes. To ensure price stability, which means inflation while keeping growth in mind. While keeping growth in mind. And your answer is C. Okay. Next question for the day is, monetary policy in India is formulated by. Monetary policy in India is formulated by Monetary Policy Committee. Okay. Yes, guys, everybody is correct. The next question for the day is, Monetary Policy Committee consists of how many members? 6 members. Okay. 6. 3 are from RBI and 3 are from government. Okay. From RBI governor will be there, Sanjay Malhotra. Poonam Gupta, deputy governor, will be there, and executive director Rajiv Ranjan will be there. And on the other side, we have Ram Singh, okay, and Bhattacharya, and Sogata Bhattacharya, and the third person is Nagesh Kumar. Okay, so 3 persons are there as of now. Okay, so you need to remember all the things. You need to recall everything. Fine. So the next question for the day is, who has the power of casting vote in MPC? In the Monetary Policy Committee, casting vote power is with RBI governor. Okay, so I have told you 6 members will be there, 3 from RBI and 3 from government side. Okay, whenever there is equal situation, RBI governor will get 1 extra vote, and that 1 extra vote is called as casting vote. So here answer is option C. Okay. Okay, the current inflation range is, I have told you, 4 plus or minus 2%. So this is your option. So option B is your answer. There's 32B. Okay. So the next question for the day is, CRR is maintained by the banks in the form of how? Cash with RBI. Okay. Now what happens here is, every bank will have NDTL, net demand and time liabilities. Out of NDTL, 4% they'll keep aside and they'll send to RBI, and this will be in the RBI vault. RBI vault. Okay. So answer is cash with RBI. So option C is your answer. Okay. So the next question for the day is, CRR is calculated as a percentage of Guys, answer 34. See, as a percentage of NDTL. I have told you, it is mandatory for every bank to keep certain percentage of their net demand and time liabilities with RBI in the form of cash. With RBI in the form of cash. So your answer is option C. Okay. So the next question for the day is SLR to be maintained in the form of, guys, 35. B, yes, government securities and other approved assets. Okay. So what are those other approved assets in capital market? We'll see. Okay. So answer here is, so how much percentage? 18%. Next question for the day is, which of the following reduces bank's ability to lend? Okay. Answers? See, decrease in CRR. If CRR is decreased, then ability to lend will increase, right? Yes. If repo rate is decreasing, then obviously lending will be, I mean, see, this doesn't has any effect on the lending ability. Okay. And increase in CLR, SLR, then obviously 18%, if it is increased to 30%, then this will reduce the ability of banking to lend. Yes. Before example, see, 100 crores we are having, 4% CRR, 18% SLR. Now this 18%, so here in this case, 78 crores that banks can lend. But if this is increased, example, let's say this became 30 crores. Now 34 crores they have to keep in the reserve. Remaining 66 only they can lend. So this is reducing the bank's ability to lend. So your answer is option C, increase in SLR. Okay. And this doesn't has any effect and this doesn't has any effect. Okay. Guys, understood? Super. Everyone is correct. Now, the next question for the day. Bank rate is. Bank rate is. Bank rate is. See? Yes? So, long-term rate without repurchasing agreement. I have told you repo rate, short-term. Here you need to put collateral, government securities. And MSF rate, overnight loans. Again, here also you need to put collateral. So, bank rate is long-term rate. Here you don't need any government securities as collateral. So this is your option. Next, repo rate is used by RBI to, why it will do? See? Yes. Guys, online guys, answer. 38th question. Yes, see. So, whenever this is RBI and this is bank, when bank is taking loan from RBI, it will pay some interest to RBI and that interest is called as repo rate. So, to provide short-term loan to banks, to provide long-term loans, bank rate, to provide overnight loans, again repo rate and MSF rate. Okay. Now, the next question for the day is repo transactions are. Repo transactions are. See? Yes. Short-term secured loans with repurchase agreement. Okay. Remind me in tomorrow's class, I'll tell you about repurchase agreement. Okay. Just remind me once. Fine. So 39 option C, everybody is correct. Now the next question for the day is, reverse repo rate is mainly used. Why it will be used? Huh? Guys, 40. B, wrong. B, wrong. C, yes. To observe excess liquidity with the banks, will use repo rate, reverse repo rate. See example, this is RBI and this is bank. Banks has more amount, they will deposit with RBI, and for that RBI will pay some interest. That interest is called as reverse repo. But along with the interest, government securities will also be provided by RBI to banks. Okay. So option here is C. Okay. So the next question for the day is, standing deposit facility differs from reverse repo rate because only two things are there. One is interest, I have told you, reverse repo rate is quite low and this is high. And the second difference is 41, guys. Online guys, I am waiting for your answer. SDF is without collateral, reverse repo rate is with collateral. Okay. SDF was, so the next question for the day is, SDF was introduced in the year? Yes, this is quite simple. 2022. I've told you, repo, reverse repo, they were introduced in the year 2000. Marginal standing facility introduced in the year 2011. Standing deposit facility is introduced in the year 2022. Fine? Understood? Okay. Now the next question for the day is, MSF allows banks to borrow funds. See? Correct? Remaining also please respond. 43. Yes, see, if you have this 18 crores, let's say, government securities, this is SLR. Okay. If you have on top of that, if you have 5 crores, if you are using this, then you will get repo rate. And if you are using this, then you will get MSF rate. Okay. So beyond SLR in emergency. Okay. So the next question for the day is, maximum limit for repo borrowing is, I have told you, what percentage of NDTL? .75%. Okay, I've told you this. See, repo, you can take 0.75% of NDTL, and MSF 3% of NDTL. Okay, this you will find as 1% in your books, guys, and this you will find as 0.25% in your books. Okay, this is very old data. Okay, before Corona. Okay, books are not updated, so please change these values in your standard books. Fine. So answer is C. Oh my God, I've told you the answer. Fine. The next question for the day is, MSF borrowing limits to 3% of NDTL. Okay. Fine. Next question for the day. What is the nature of open market operation? See, I have told you this. I need answer from everyone. Huh? Yeah. Yeah, see. 46 B, permanent in nature and for long term absorption. Okay, repo rate, these all things, liquidity adjustment facility, they are temporary in nature and they are for short term. Open market operations, that is permanent in nature and that is for long term. So your option here is B. Yes, online guys, everyone is correct. Okay, so the next question for the day is, which of the following is permanent tool for RBI to manage liquidity? Now tell me the answer. Same, quite simple. Permanent. Open market operations. Yes. Liquidity adjustment facility, which means reverse repo rate, MSF, STF, all these things are temporary in nature. Open market operations, permanent in nature. So your option is C. Next question for the day. Margin requirement is. Now tell me margin requirement. Please answer everyone. Margin requirement guys, 49. B. Yes. See, I have told you three things. One is collateral. If your collateral is 100 rupees, then you will take care of LTV. LTV is what percentage of value of your asset they are giving in the form of loan. Example, if it is 70 rupees, then this is your LTV. Remaining 30 is nothing but margin requirement. Margin requirement. So the total percentage of value not given as loan. Okay. This not given as loan, this given as loan. Understood? Next question for the day. RBI increases margin requirement to, they have given 4 statements. When RBI will increase margin requirement? 50? Guys, 50. Yes, Sanna correct. Sudhir correct. Not even a single guy is doing mistakes. Yes. If margin requirement, let's say value of the asset is 100. Okay. Margin they have kept 30 and they have provided loan 70. Okay. If they are increasing the margin, which means 50 or 40 they are keeping and 60 only they are providing, which means discouraging excess lending against risky assets. Okay. So the next question for the day is, consumer credit regulation controls. What it will do? Consumer credit regulation controls. Yes. Guys, I need answer from you. Yes. Yes. Consumer credit means it will control the loans against consumer goods. Okay. What it will do? If somebody is providing easy loans, it will come into the picture, RBI, and it will make those easy loans difficult. So, to control easy loans for consumption goods. Okay. Because these are non-productive. Yes. Next question for the day. Credit rationing means. Credit rationing means. Huh? 52 B. Yes. Srinidhi, super. B. Correct. See, I have told you. Certain sectors, it will limit the loans. Example, I have told you agriculture sector, industrial sector. Okay. So, answer here is B. So, the next question for the day is, priority sector lending is an example of, huh? See, this I have already told you in the class, and I have given you a note as well. Priority sector lending is nothing but an example for positive credit rationing. Okay. The next question for the day is, moral suasion refers to. I've told you three things. Yes, moral pressure, not legal, and not binding on the banks. Now tell me the answer. Advisory request by RBI to the banks. So moral suasion means moral pressure created by RBI on banks. This is not legal. Even if they are not following also, we can't do anything. And it is not binding on the banks. It is not mandatory for them to follow. Okay. So option here is C. Okay. Now, the next question for the day is, direct action by RBI involves. Yes, penalizing banks for disobedience, which means legal action will be taken. Okay. So answer here will be C, guys. Okay. Next question for the day is, which of the following is not a qualitative tool of monetary policy? Which means one is quantitative tool here. What is that quantitative tool? Repo rate. Repo rate is the quantitative tool. I mean, these kind of questions they'll ask you in UPSC. They have asked also. Okay. Next question for the day. See, which of the following statement is true? Tell me the answer. CRR affects rural banks. See, CRR is quantitative tool. Whenever you are making change in the quantitative tool, entire economy will be affected. Which means both rural, urban, every bank will be affected. So this is wrong. Repo and reverse repo are long-term tools. No, they are short-term tools. Open market operations has permanent effect on liquidity. Yes. And bank rate is used to absorb liquidity. No. Reverse repo rate, standing deposit facility are two things which are used to absorb liquidity from the banks. Okay. So here option here is C. Now the last question for the day is, the next question for the day is, which of the following best differentiates qualitative and quantitative tools? Quantitative and qualitative tools. Now tell me the answer. See, quantitative tools decides where credit should go. Qualitative tools decides how much. Quantitative is equals to volume control. Qualitative is equals to direction control. So this is your answer. I've told you. Quantitative, it will change the entire economy. Qualitative, you'll fix the target. Example, agriculture sector, it will go into agriculture sector. Service sector, it will go into service sector. So this is your last question, and the answer is B. Okay. Thanks a lot, guys. Again, I'll tomorrow we'll be discussing the concepts. Okay. After 2-3 concepts, I'll get questions like this so that you'll get some confidence what you have learned. Okay. Chalo then, bye for today. I'll meet you guys tomorrow. Exactly 1 hour.